Hi, everyone. Thank you so much for inviting me to present at the TASK Actuarial Convention. It's really a privilege to be invited to speak here. And I'm really excited about the topic that I have to present today. So let me start by introducing myself. My name is Jeremy Gray. I'm a Senior Engagement Manager, and I lead the risk team at Cenfri. Cenfri is a non-profit think tank based in Cape Town. And our focus is on encouraging the development of financial markets across the developing world, with a particular focus on sub-Saharan Africa. And as we all know, all of our plans this year have been thrown into significant disarray with the advent of the COVID-19 pandemic. And economies around the world, across different sectors, have been hugely impacted by both the health impacts of the pandemic, together with the economic impacts resulting from government shutdowns, similar mechanisms to restrict the spread of this pandemic. Insurance has been similarly affected across different markets. And so in the early part of this, or the first half of this year, mostly between April and June, July, we took the opportunity to try and understand what the impact of COVID-19 has been on insurance markets across the continent. We undertook interviews and surveys with both providers and regulators across the continent to try and understand what the immediate impact of COVID-19 has been on the insurance sector and what the medium and long-term implications of the pandemic are and are likely to be on insurance markets in sub-Saharan Africa. So today I'm going to present to you some of the findings from that research, and I'm going to, particularly some of the key trends that have emerged, together with what I would see as some of the key implications moving forward for the different players across different markets on the continent. So if we could just go to the presentation now and share my slides. Let me start by showing you this slide, which just highlights the different ways in which we collected information on the impacts of COVID-19. So we conducted a survey together with the Organization for Eastern and Southern African Insurers and FSD Africa, which interviewed 68 different insurance providers across Eastern and Southern Africa, so including Kenya, but across the entire region. And then we also did a series of 47 interviews with both insurance providers and insurance regulators across the entire continent to try and get a sense of the impact of COVID-19 across the different markets on the continent. And I think the biggest theme that emerged for me from the study was that COVID-19 has not so much created new issues, but has rather highlighted and pressured existing weaknesses. We found that COVID-19 itself didn't tend to create new issues within insurance markets, but rather placed more pressure on existing fissures. So where there were existing weaknesses, COVID-19 really exacerbated them. And in some cases, COVID-19 also highlighted some real strengths across different markets. I think some of the role that in some of the markets, the role that regulators played, for example, in proactively communicating the impact of COVID-19 to their licensed entities, really highlighted some of the strengths of some of the different regulators on the continent. So we found three major themes that emerged from the research that we did. The first is that there was an urgent need for digitization and for an immediate need to shift operations to remote locations. And I think that this applied across virtually all sectors of the economy, and in insurance was no different. We saw that in the immediate aftermath of the lockdowns that we saw across the world, insurers were forced to think about how to digitize their operations, and regulators similarly. In both cases, there were many practical considerations. Things like how do we make sure that all our staff have access to laptops and access to the internet or online communications. And as a result, we saw a massive spike in the digitization of processes across the industry. In some cases, we spoke to insurers who mentioned that digitization of their processes was something that was a strategic priority for them even prior to COVID-19. But what they had planned to do over the course of 2 to 3 years, they were forced to do in the course of 2 to 3 weeks as a result of COVID-19. So the pandemic really acted as a trigger to drive the digitization of many parts of the industry. I think what we've seen, and this slide shows that just what a large proportion of respondents in our survey said that as a result of COVID-19, the slide on the right, they had digitized different parts of the insurance value chain. And I think what we've seen over time is that some parts have been digitized quite effectively, but certainly other aspects of the insurance value chain have been far more challenging to digitize. In particular, the interactions with consumers have been the hardest part of the value chain to digitize. So sales of new policies have certainly lagged the other aspects of the value chain in terms of the effective digitization. The second key theme that we saw is the impact on insurance balance sheets. And I think that this will come as no surprise to you, but COVID-19 had a significant impact on insurers' ability to continue to earn premiums and has significant balance sheet impact. So here, this slide shows from the survey the proportion of respondents that indicated that they had seen a reduction in premiums collected, a reduction in new sales, a reduction in renewals, and an increase in lapses. All of that clearly leads to a reduction in the overall level of premium income and premium revenue that is being collected by insurers across the markets. That places significant pressure on insurers' balance sheets from the revenue collection side of things. But from the other side, we also saw a significant reduction in the value of assets on insurers' balance sheets. So whilst their premium revenue was being reduced, the value of their existing assets was also being reduced by the pandemic. We saw particularly, at least initially, stocks on the stock market fell in many countries. In some countries, we've seen the value of government securities fall. In Zambia, for example, the government has been unable to repay all of their debt. And certainly in terms of some of the more illiquid assets, like property, it's not only has the value of those assets fallen, but they've also become more illiquid and therefore harder to liquidate for insurers. And this slide, I think, really highlights that to quite an astonishing extent. It was certainly one of the most stark findings for me from the survey, was the proportion of respondents that said that they were either very concerned or at least somewhat concerned around their sustainability. It's quite a stark finding, I think, when you see that 76% of respondents said that they were concerned about their liquidity. 68% were concerned about their solvency. 60% are concerned about just maintaining minimum capital requirements. This really highlights the extent of the prudential impact of the crisis. And as much as we've come through the immediate aftermath and the most immediate impacts of the crisis, I think the full impact is still very much with us. And I'm going to come back to that in a bit, because I think this is a fundamental point in terms of what we'll see as the impact of this pandemic. And the third key theme we saw was around the uncertainties and exclusions related to different products. So what we saw, and I think many insurers have had to engage with this, is that COVID-19 or pandemic-related risk was not included in many insurance contracts, or for that matter, in many reinsurance contracts. So you can see the colors on the left, on the left-hand side, illustrate where pandemic risk was explicitly excluded, and the section on the right-hand side illustrates where it was a gray area. Pandemics were neither included or excluded. So, for example, for business interruption risk, 26% of respondents said that pandemics were neither explicitly included or excluded from their reinsurance contracts. And it looks very similar when looking at insurance policies. And we know that this has been a consistent theme across the world. And in the case of business interruption, has been the cause of a number of lawsuits across the world. I think we've seen in the UK, in France, and in South Africa lawsuits related to this. But what's particularly interesting is then looking on the right. So those respondents who said that COVID-19 was essentially a grey area in the existing contracts, a large proportion of them in those instances decided to exclude them. So both from the reinsurance side, and then in turn from the insurance side, where the pandemic risk was a grey area in contracts, particularly on the general side of the business, it was decided in most cases to exclude that risk. Now, this has a significant implication for the level of trust in insurance as a concept for the consumers across the market. Because businesses with business interruption risk, as an example, generally feel as though a pandemic like COVID has led to a significant interruption of their business, and therefore insurers should pay out. And yet insurers took the exact opposite view and said, we should not pay out on this, even though it's not explicitly excluded from our contracts. Now, clearly there's huge prudential illustrations, as we've just seen here, prudential reasons as to why insurers took that stance. But it does have significant implications in terms of how we think about consumer protection, and certainly in terms of how we think about building trust in the market. So with that, let me move to the implication and opportunities, because I think this is where the most important implications and themes arise. So the first is that what COVID-19 has done is, I think, has led to a further erosion of trust in insurance amongst many target markets across different countries. And to some extent, I think insurers have been placed in an impossible position, because had they paid out on all policies, we may well not have any of those insurers still with us, as we saw the highlighted prudential risks. But we know that across the African continent, trust in insurance is already extremely low. And now we have seen a massive risk that has affected the entire society, and yet insurance has not played a particularly decisive role in helping people to deal or cope with that risk. That's not a great outcome for markets that are looking to grow insurance and to sell insurance to new customers. That perception of insurance and trust in insurance has not been strengthened, unfortunately, by this crisis. One of the initial implications is that there's been a significant level of digitalization, as we saw. And I think that that level of digitalization does have significant opportunities over the medium to long term, particularly where digitalization has been effectively embedded by insurers. We should see levels of enhanced efficiency as a result of that. And the last implication is that I expect to see quite significant market consolidation across at least some countries. The level of prudential risk that we highlighted in the previous slide highlights the challenges that many insurers are facing in complying with solvency requirements. And it would be highly unlikely that we see no failures across most insurance markets. And that would lead to consolidation in the industry. I think that consolidation in the industry in itself actually creates a significant opportunity. So research that we've done in the past illustrates that the level of fragmentation across many African markets is a challenge for the development and innovation within those markets. The fragmentation leads to highly competitive markets, which often leads to things like undercutting behavior and heavy competition in areas like third-party motor vehicle insurance because it's compulsory. That heavy focus leaves many insurers with limited capital reserves and limited ability to invest in reaching new target markets, which may have a slightly longer term turnaround in terms of achieving revenue targets, and they don't have the capital to invest. So I think consolidation of the industry, although painful over the short to medium term, over the long term may be of benefit in terms of opportunities to digitize. And so that brings me to the key focus areas. For regulators, I think that there's a critical need for them to be proactive in managing the consolidation of the market in the short term. many failures and inability of insurers to honor claims because of solvency concerns will lead to just a further erosion of trust in the industry. So regulators that can be proactive about unwinding weak and vulnerable insurers and allowing them to exit the market in a proactive and effective fashion can lead to market consolidation over the longer term to the benefit of the industry as a whole. Secondly, they need to communicate clearly. And thirdly, I think really emphasize innovation and opportunities for innovators. A period of disruption like this does lead to substantial opportunities for innovation. And certainly in Kenya, the IRA has been quite proactive in launching the Regulatory Sandbox, Regulatory Innovation Hub, and launching the microinsurance license, as well as considering other licenses like cell captives to encourage innovation in this market. And then I think enabling remote sales and onboarding is really key for regulators. The need for remote sales has really been highlighted by the pandemic. It's something that's challenging for insurers to overcome, but from a regulatory perspective, it requires coordination between to allow digital contracting, remote onboarding of AML CFT, and in order for effective onboarding through remote channels. And then for providers need to take a sober and realistic assessment of what their financial position is to inform a sustainable strategy. I think the erosion and value of assets is a key consideration for them to for many insurers, and is quite challenging to effectively measure their financial positions as they currently stand. Because of the illiquidity of assets, insurers may be taking forward engaging in a strategy that is not informed by their true financial position. So I think taking cognizance of that and assessing it to their best ability, I think is really quite important in this time of fluctuation. I think additionally, as much as we've seen the initial impacts of the health crisis and particularly the government response in terms of lockdowns has passed, I think that we see significant impacts on overall GDP and significant reduction in demand for consumers. So the full impacts of the crisis, I think, are still with us, and the level of reduced sales, reduced premiums, and lapse rates, I don't think are going to be reduced in the short term. So we really need to be realistic about when we're going to see a full recovery and how to respond to that. I think additionally, engaging the digital process and making sure that the digitalization that has happened and been triggered by COVID is embedded is a real opportunity to improve the efficiency of insurers. But I think it also needs to be thought through quite carefully. So, for example, when engaging with consumers, making sure that those digital processes are consumer friendly, that the consumer journey really works for consumers and enables them to engage. And then lastly, I think it's important for insurers to rethink their approach. Rather than just thinking about how to offer insurance, I would suggest flipping that question around and rather saying, who are our customers and how do we build resilience for customers? How do we meet their needs? And I think that that's quite a fundamental approach, and particularly when we think of MSMEs, who are so fundamental when we think about the COVID-19 recovery, that is a crucial question to ask, because insurance policies as they currently stand are on the whole not working for SMEs. There is very low take-up for the SME target market, despite the fact that there's a real need for resilience and insurance-type coping mechanisms. There's very low take-up because the insurance products are not effectively designed to meet the needs of those SMEs. And I think flipping that question around and saying, how can we build the resilience of those SMEs may lead to quite a different solution. Thinking about how we can do proactive risk management, how we can think about risk prevention more and resilience more holistically, rather than just developing insurance products to sell. I think rather thinking about creating a long-term partnership and a solution for building resilience with enterprises and with individuals as well. And then lastly, I think there's a real opportunity here for alternative providers and partnerships. So I think partnering with people like industry associations, with digital platforms, for example, who have reach into these target markets, and in the case of platforms, for example, may also have already be digitized and engage with their consumers through digital channels already, may offer real opportunities to extend the reach of insurance and to do so in this unique and new post-COVID-19 environment through which we operate. So thank you very much, and I hope that that was quite useful. And definitely, you are welcome to feel free to reach out to me at any time. I'm sure my details will be shared by the conference organizers. Thank you.